Part of the problem with how people use support and resistance is that although most are aware of the different basic ways a market can respond to a technical level, they often are not taking into account when executing around a level. A market does not have to instantly bounce from a level, and this is a dangerous way of thinking that's easy to get sucked into. A market can breach a level only to turn around and reverse back to where it came from. A technical level of support and resistance is merely a reference point for subsequent activity, and this must be at the forefront of a trader's mind when looking for clues to take their next trade. Now, before we get into how a market can respond to a level, it's absolutely crucial to cover rotations. A rotation is simply a definable leg within the market movement. It doesn't have to be a big directional swing. Think of it in terms of breathing. A market must, just as a living creature, breathe in and out. In a bigger directional move, there are still counter rotations to the move. You can think of these in terms of breathing out, the expulsion of stale air or market energy in readying for the next intake of breath to fuel the next rotation in the direction of the bigger move. The key point is that it's always happening, and by identifying the size of the last swing, you can get a better feel for whether enough energy has been expended in order to encourage the other side to push the market in the opposite direction, at least by enough for what you would consider to be a small rotation. Now, of course, the size and distribution of rotations is highly dependent on the product and the time frame that you're looking at. To extract this kind of information from the market you're looking to trade is far easier if you have the kind of software to do most of the work for you. If not, you can select a period and just do it manually. What you'll end up with is a distribution and what has been the most common size rotation over the period of analysis. By tailoring the time frame you trade and the general scale out size to take the market's rotation profile into account, you can get to a point where your trades have a much greater probability of becoming safe, even if they don't end up being big winners. Put that another way, understanding rotations can help you get in sync with the market flow. Okay, so now we have some basics about rotations as a foundation. Let's look at the ways the market can react to levels of support and resistance. First of all, it can bounce from or a tick or two before the level itself. Like in all cases, a market can bounce with a counter rotation of sufficient size. However, before the counter rotation is sufficient in size, it looks like this. At this point, the market can continue up and form a reasonable bounce, or it can continue to move lower, but at the same time be moving back and forth by a handful of ticks each time it does. Now at this point, it's a little bit premature to make assumptions based on the information that the market's giving you. Once the market has moved a full rotation, however, the chances of it pulling back to the level and then at least attempting a secondary push in the same direction are much higher. Now the second basic way a market can react to a support and resistance level is by just going right through it. Again, for a greater chance of the break to at least have a secondary push after pulling back to or somewhere towards the level, the simple requirement is that the break is by a number of ticks that, by studying the market, has been identified as a common size for a rotation. The last basic way, and the one often catches people out, is that the market can breach a level by a small number of ticks and then only begin to reverse. Now, there are, of course, many different combinations that the markets can conjure up to throw us off course. Now, indeed, the market does not have to do anything. But we're not expecting certainty, are we? Now, a market can look like it's already reacted to a level in a certain way. It might look like it's bounced, for example, only to run through the level on a retest. It might look like it's broken the level, but really it's trapping sellers in the examples that were used here. The key thing here is to get your timing right, and to do this, you can leverage your understanding of rotations. If a market bounces from or breaks through a level by a decent number of ticks, what it's telling you is that it had enough energy on that side to gain that reaction, and at least an additional secondary test in that direction is therefore likely after any pullback. It might continue to reverse or power on lower. In fact, it may never give you a decent pullback at all once you've spotted how it's initially behaving. But until you see how the market reacts, it's extremely difficult to judge the nature of other traders and what they want to do at the level. The importance of identifying key technical levels of support and resistance really can't be overstated. However, without considering how a market can react once it gets there, you're at risk of making an error in assuming it will do one thing or the other, either bouncing after the pullback from the level by just a handful of ticks, or making a big move on a breakout just because the price is traded through by a tick or two. Understanding rotations and market energy is just another part of unlocking the power of levels. You get that right, and you'll potentially improve your timing of trades significantly.